Hey everyone, and welcome to this explainer. I am seriously so excited to share this with you today because we're about to break down a massive, fundamental shift that's happening across global markets right now. We are basically moving out of this era of pure digital hype, and we're slamming headfirst into some very hard physical realities. It's a massive shift we call the friction economy.
So let's jump right in with a question that's going to anchor our whole journey today. What exactly happens when infinite investment capital collides with a finite physical world? I mean, for the last decade, we've basically been conditioned to think about scale in terms of software, right? Infinite replication at zero marginal cost. But here's the thing. You can't just copy-paste a copper mine. You can't hit refresh on a semiconductor fab or an electrical grid.
To figure out what that collision looks like, here's our roadmap for today. We'll start with the market reality check, then look at AI's physical hardware bottleneck, the autonomous defense revolution, the rise of humanoid robotics, how to filter small-cap quality, and finally, wrap it up with the great CapEx convergence.
All right, part one, the market reality check, setting the baseline. Right now, we are looking at a really stark contrast in the markets. Equities are kind of desperately searching for direction. You've got the Dow crossing that 52K threshold, but at the exact same time, tech weakness is heavily weighing down the Nasdaq. Meanwhile, the U.S. 10-year Treasury is sitting at 4.40%, which pretty much neutralizes zero-yield safe havens. But honestly, the most alarming part is the liquidity alert. Just think back to 2022. 85% of private credit withdrawals were honored. Today, that number has plummeted to just 12%. We're looking at private credit traps restricting exits for the fourth consecutive year. Capital is literally being locked in place.
And this feeds right into the inflation story. If you track those volatile energy and fuel spikes, falling oil prices do give us some temporary cover, sure. But look at core PCE. It is stubbornly holding at 3.4% year over year. That kind of sustained resistance puts the Federal Reserve in an incredibly tight spot. So what you really need to take away from this is that despite the market practically begging for rate cuts, the odds are actually increasing for rate hikes instead.
Which brings us to a number that should honestly make every single investor sit up and pay very close attention. 90%. We're not talking about a little rounding error here, folks. This is a massive historical disconnect.
That 90% represents what we call a massive exuberance gap. When you look at the current 12-month forward consensus for earnings per share, it is nearly 90% above the trailing 10-year average. We saw these exact same warning beacons flashing in March 2000 and again in October 2007. Look, strong momentum is great, but a market pricing an S&P 500 target of 8,000 based on this kind of euphoric sentiment, rather than sustainable fundamentals, that leaves things exceptionally vulnerable to a reality check.
Moving on to part two, AI's physical hardware bottleneck, capital versus reality.
To really wrap our heads around how this plays out, think of it as a three-step process. First, we have the massive, sky-high ambitions of the tech hyperscalers. Second, those ambitions smack right into hard physical limits. And third, the exhaust from that massive collision gets passed directly down to you and me in the form of consumer inflation. Let's look at the wide top of this CapEx bottleneck. You've got AI capital expenditures scaling incredibly aggressively, projected to hit $1.1 trillion next year alone. But then we hit the choke point. You literally cannot shove $1.1 trillion of digital ambition through a tiny physical bottleneck made of copper, memory chips, and cooling fans. The physical supply simply cannot meet the digital demand. And the result? Big tech can't build their AI utopia without passing the hardware bill straight to the consumer. That's exactly why we're seeing Microsoft hike Xbox console prices by $100 to $150 and Apple forcing price hikes across their brand new product lines. So here's the kicker. This creates a massive margin transfer. On one side of the equation, we have value leakage happening with the big tech consumer brands. On the other side, we've got value capture happening with the physical component suppliers.
We are seeing this value chain transfer play out viciously in real time. Take Apple. They recently suffered their worst trading day since April 2025, dropping over 6%, because their margins are being severely threatened by the sheer inability to internalize all these wild AI hardware costs. But on the flip side, semiconductor manufacturers and component suppliers are actively extracting that exact margin. Micron Technology surged 16% on blowout earnings, wielding massive 85% gross margins. In the friction economy, the folks selling the physical shovels are the ones extracting all the wealth from the tech gold miners.
All right, part three, the autonomous defense revolution, asymmetric warfare.
The asymmetric economics at play here are just absolutely staggering. Traditionally, we've relied on exquisite, insanely expensive weapons systems. $4 million Patriot missiles, $150 million F-22 Raptors, a $13 billion aircraft carrier. But the scale is totally tipping. It's being weighed down by thousands of agile, disposable, $500 autonomous drones. Decades of U.S. military dominance built on these high-cost systems are being completely upended. It's now totally economically viable for smaller actors to hold superpowers at bay, just purely through volume. And look, the Pentagon knows this, which brings us to the DAWG catalyst. DAWG stands for the Defense Autonomous Warfare Group. You got to hear these numbers. Their budget is exploding from $225 million in fiscal year 26 to an unbelievable $55 billion in fiscal year 27. They are forcefully creating a $100 billion annual market for lower-cost, high-volume autonomous systems out of thin air. In this brand-new budget reality, it's pretty clear who wins. Legacy players like Boeing and General Atomics, with their complex, crude, incredibly expensive systems, are suddenly at a huge disadvantage. That massive DAWG catalyst is pulling all the momentum towards agile, disposable, pure-play autonomous systems. We're talking about swarmer companies, places like AeroVironment, Red Cat Holdings, Avex. These are the companies perfectly positioned to just scoop up that explosive $55 billion budget shift.
Which brings us to part 4. Enter humanoid robotics logistics automation.
Meet Digit from Agility Robotics. Guys, this isn't sci-fi anymore. It's happening right now, in active deployment. Check out those reverse-jointed legs. They aren't just an aesthetic choice. They are specifically engineered for logistics, for navigating uneven surfaces in warehouses. Plus, it operates on a robot-as-a-service lease model. And the adoption ecosystem is already huge. Giants like Amazon, GXO Logistics, and Toyota are actively testing and deploying this tech. They're gearing up to be the first U.S. pure-play public humanoid robotic stock, going toe-to-toe with heavyweights like Tesla's Optimus. The sheer physical constraints of human labor are being actively solved by hard engineering.
Part 5. Filtering small cap quality. Navigating the market. So how do you actually invest in all this? Well, you have to be super picky. If you want exposure to these dynamic tech and manufacturing shifts, you can't just go by any broad small cap index. Take the Russell 2000. It uses a size-only methodology, which means it inherently drags along a ton of junk companies. On the other hand, the S&P Small Cap 600 requires proven profitability before a company even gets a foot in the door.
And that difference in methodology, it makes a massive difference in real-world returns. Because the Russell 2000 holds on to demoted junk during its rebalancing, what we call summer baggage, it lags significantly behind. The S&P 600 weeds out the duds, giving it a 600 basis point cumulative total return advantage over 30 years. There's actually a fantastic academic study by Wang and Barkadin called I Know What You Did Last Summer. It mathematically proves that if you freeze a small cap index and strip out the baggage of demoted or fresh IPO companies, returns improve by 1.57% annually. The takeaway here is simple. Not all small cap indices are created equal. Quality filters are absolutely non-negotiable in a friction economy.
Finally, Part 6, the Great Capex Convergence, bringing it together.
When you step back and see how these massive macro forces overlap, the implications are just profound. On one side, you have AI infrastructure, $1.1 trillion, demanding practically infinite chips and power. On another side, autonomous defense, that $55 billion budget demanding infinite cheap drone components. And rounding it out, supply chain reshoring, hitting the absolute physical limits on manufacturing capacity and raw materials. Where all three of these massive trends slam together right in the middle, that red-hot core is the friction economy. It is the exact point where all this capital exuberance finally hits the immovable wall of physical reality. I'm going to leave you with this one final powerful thought to chew on today. The underlying narrative of the current market is not a software revolution. It is a global scramble for physical, hardware-based supremacy in a resource-constrained world. Software might be eating the world, sure, but it still needs a physical plate to eat it on. So are you investing in the illusion of infinite digital scale, or are you actually positioning yourself for the realities of the friction economy? Thanks for hanging out with me on this explainer. I really hope this helps you see the markets in a totally new light.